Good afternoon and welcome to Chicago Future of Finance. I'm Oliver Rennick. We got a little off day here in stocks. Equity's getting hit. Nasdaq's down over %. VIX is popping a little bit. So it might get a little bit noisy in here. It's a pretty busy day here at the SIBO floor in Chicago, downtown. This is week 3 of Chicago Future of Finance. Last one here in downtown Chicago before we go on a little vacation. Next week, Tuesday and Wednesday, live from the Hood Conference, the Hood Summit rather, in Las Vegas. That's going to be a special show. It's going to be a lot of fun. I'm hosting a panel, I'm doing a podcast, talking with traders, getting into the weeds about what's working and what's not for traders this year. And then after that, the week after, is RMC Munich, the Risk Management Conference from Europe. Institutional. We'll be careful what we tweet while we're over there because they're a little dicey when it comes to social media. But here we are in American Chicago and downtown, and the market has some fun action for us today. We got a great show coming up. We're going to start to really get into the weeds. I'm really looking forward to a conversation we're going to have right off the top of the show today with Jason Hicks from Matrix Executions as we start to really get into the nitty-gritty, the market structure, and the dynamics that make this place unique, as well as a lot of things you probably don't know about market structure, the way the pipes are connected, the infrastructure of markets, what matters on the minutia when taking at grand scale when it comes to trade execution. That's going to be a really fun conversation that's going to give us perspective and an important grounding for discussions in the coming weeks about what's happening beneath the surface and sometimes beneath the obvious of what you're doing and how it affects you, both as an individual trader and for those operating bigger institutions. We're going to do a little gambling and look at some of the stuff on Kalshi. I'm riding solo on that one today. That'll be fun. We're going to talk international themes and looking at some of the geopolitics. James Perry has a very unique perspective on things, and I'm looking forward to that conversation. We're going to talk retirement and big themes with Marta Norton as well from Empower, a shop that advises and manages almost $2 trillion, which is pretty incredible across millions of clients coming to one of the biggest retirement vehicles around. So that's going to give us some really good perspective on how she's thinking about the market, which is getting pretty interesting, by the way. Charlie Moon's going to join us in the second half of the show as we close out looking at the risk radar and looking at some of the momentum trades from Prosper Trading Academy. That's an important one. Let's check out some of the stuff here in the session so far, as we do have a little bit of pressure in equities. I want to run through some of the big movers real quick. Firstly is that the chips are getting hit pretty hard. SMH is down almost 2% right now. NVIDIA is getting smacked around as well, trading below 170. The chart for NVIDIA is a little bit rough right now. This is not really the look you want, obviously, from the leader of the AI trade after earnings that were generally sufficient at first glance. But now that we're drifting towards levels that we haven't seen since the summer, you really needed to hope that NVIDIA finds some support and that it finds support pretty quick. The other thing that's interesting is the fact that the dollar has remained pretty firm and looks to be in somewhat of a channel moving higher. And likes the dollar firming up is bonds weakening. The TLT here you see slipping to 85.6, also the lowest really since July. Still largely range bound, I'd argue, for bonds, but the situation is getting more interesting with some economic data generally firming. Even though folks are looking for cuts, the action today tells you otherwise. Higher dollar, lower bonds generally does not look like cuts. However, any sign of risk on? Look at IBIT bouncing back in the Bitcoin Trust, up 2.5% to almost $63. That's a pretty decent look for Bitcoin after softening substantially over the last 2 weeks and being a little bit perhaps now of an arbiter of weakness in the broader market. Alongside Bitcoin today is MicroStrategy finding a little love, up 2.3%, holding the range in the mid 300s that it's been in. We'll come back and get into the market in the weeds with Brent Kochuba shortly. Right now, let's talk about what happens here behind us and really what really makes Chicago unique, and that is the infrastructure, the market structure, and the execution that happens here in the Windy City. Jason Hicks joins me, Senior Sales Executive at Matrix Executions, here on the floor. Jason, it's great to have you.
Oliver, thanks for having us.
This is a cool spot because you have a really good insight into how things connect. I've learned a lot from you over the years viewers. What's going on back here? Tell me from your perspective as somebody who knows a lot about execution, and this is the most active physical exchange, but there's, 18 other exchanges out there too?
18 other exchanges. What's actually happening here on the floor, there's two categories of people. There are brokers bringing interest to the floor, and there's locals or market makers that are sitting there waiting to trade against that interest, right?
Okay.
So these brokers, they bring a paired offer and a purchase to the floor. They can't just cross it without having everyone else give them a look, right? So what happens is, as you hear sometimes, the locals, the market makers stick their hands up, hey, I want a piece, hey, I want 5%, hey, I want 10%. And this is what's happening here on the SPX floor.
VIX is a little bit lively today. SPX and the index options, SIBO does almost all of it.
It does all of it.
All of it.
And specifically what's going on the SPX floor is that electronically you cannot cross an SPX product during the regular trading session for larger than 10 contracts at a time, right?
Okay.
So it's got to come back here, right? So that's why it's still one of the most active, if not the most active physical floor here in our space.
When you're thinking about execution and where things connect, how much do the other 17 exchanges factor into that process? I mean, everybody's kind of got their sweet spot. When it comes to equity and options trading, it gets a little bit more distributed, but it still is very much focused here.
Sure. Well, outside of SPX, outside of the single listed products, as a broker, you need to connect to all 18, soon to be 20 by the end of 2026, right? So if you're trading SPY options, if you're trading MicroStrategy, if you're trading IBIT options, any of those multiple listed products, it's not just a SIBO world, it's an all 18 options exchange world. Okay. So you have to connect to all of them. If there's liquidity on one of those floors you're not connected to, and your customer is looking for the interest, you're going to get a phone call. You might even lose a customer, right?
Okay.
So it's paramount that outside of SPX and VIX to be everywhere at the same time.
Okay. What I kind of think, is it correct the way I've described it to people that some people back here are monitoring the machines, the others are kind of fighting against them, trying to find a little bit of edge? I mean, is that still where every single millisecond or any proximity of physicality that can bring you something, to your client?
No, absolutely. There's, you have, again, brokers were on the brokerage side, but on the other side of the trade, you have prop shops, you have market makers that are looking at every single tick of the underlying, their perceived view, their opinions on volatility of the market to see, hey, maybe I can get a penny here, maybe I can. Absolutely, that's a fair characterization.
There is a lot of people like to assume, and obviously the algorithmic trading and the machines have dominated a lot, but they kind of assume that then, as similar analogously, the way people talk about, I think, ChatGPT and AI in a way too, is they forget that people are programming these things and they're doing things that we're telling them to do still.
Yep.
The fact that number of exchanges is growing, to your point, 20 coming, and a seventh exchange operator, IEX, I mean, that means they must be adding value. They must be adding something to this equation still if people are finding that there is a market for this and it's growing.
Right. You're absolutely right. And that's actually the biggest, probably the controversy in our space is another set of exchanges worth it? You have the market maker community that has a quote on all those. They have all those symbols, the options on all those symbols to put up a bid and an offer. Then you have us on the brokerage community. We have to connect into them and send the orders there. So to the extent, yes, there's perceived the value add, but that's probably the biggest argument back and forth happening in our industry right now.
Okay. I speaking of AI, I got a question that we asked the AI.
Okay.
Let's roll it here. I asked, how much does trade execution really matter for the everyday investor? And the ICTV AI says the easy answer is not much if you buy and hold forever. Small slippage doesn't matter. But in practice, most everyday investors trade more than they think, and that's where execution starts to compound. It's not about account size, it's about routing. Institutions get midpoint fills, retail often gets funneled into, quote, good enough pricing. Execution can become the invisible fee that adds up, and behavior magnifies it if you're over trading. What do you think about that answer as it pertains to how the everyday person should think about what's happening?
Right. I like to use this concept of execution alpha, right? Like how can I get the best price for the everyday trader, everyday investor as quickly and as efficiently as possible? And certainly if you're buying and holding, it doesn't matter. To the AI's point, it doesn't matter. If you're over trading, bad fills accumulate, right? They accumulate, and then over time, that leads to poor execution alpha, which leads to less capital in your account.
It can add up.
It can
basically.
absolutely add. Yes.
Now, all right. Now, what about because really, obviously, what you're doing and your work is talking with the bigger institutions, the people who are putting on bigger size. What do they need to see from execution? How do you demonstrate value? How do you go and say, hey, we're doing it better than they are doing
Sure.
it? Like, what is that? What are the mean streets of execution look like?
Right. There's a couple metrics that people like to measure on. There's the explicit execution costs.
Okay.
If you're ripping the screens, if you're lifting offers, and if you have an institutional size order, there's exchange take fees that over time accumulate, right? So there's that. And then there's something called price improvement, or what I like to call execution alpha. How far inside the FAR, let's assume you're a buyer, let's assume you're lifting an offer, how far inside the FAR take can I get a fill, right? Penny, 2 pennies, 3 pennies. Over time, again, that execution alpha number accumulates, and that can turn into real significant numbers, thousands, tens of thousands, millions of dollars. And that's something that we track, right, on top of giving the access to the options markets. We monitor that. We make sure, A, the fills aren't slipping from just a routing perspective, and then B, that the fills are good from an NBBO perspective.
This is also implicitly a discussion about market efficiency, the efficient market hypothesis, which kind of gets blown out of the water
Sure.
from this because this is all about inefficiencies and finding and plugging leaks, right?
Right. No, absolutely. If a bid or an offer stands out, someone's going to hit that bid, lift that offer. You know, that's the machines are that good at this point. So to your exact point.
How does the explosion of retail trading, the post-COVID options boom, this trend that hasn't stopped,
right,
how much of that is creating opportunity to find those midpoints and to wring out more from this entire operation, essentially?
No, absolutely. So with the retail boom, like the retail brokers are really focused on a tight bid and a tight offer and getting filled inside the spread, basically, right? So what a broker can do is, because of that, it's forced the edge to be given back almost to the retail community who's trading more and more. They're expecting better. They want more.
Yeah. Tell me about the products that you see kind of making the biggest splash, the biggest waves. You've got really good insight into who is, I'll say, stressing the system.
Sure.
But I use that term in a positive way.
Yeah.
Changes, new products. I think about some of the buffer stuff that we've been talking about a lot. Calamos is doing auto callables.
Right.
You know, there's a lot of things that are moving from the options trading world into the more packaged product world.
Sure.
That's going out to advisors. It's starting to put some pretty heavy volume onto the system. What stands out to you as being meaningful or momentous right now?
Sure. The biggest one that comes to mind are flex options. Those have been around for a long time, but you can definitely see, the uptick in trading there. We do about 58,000 contracts a day. They're about 1.2, 1.3 contracts a day as far as volume goes. And there's different product sets. There's different use cases on that. To your exact point, there's still some microstructure stuff that needs to be ironed out, because it's not an easy thing from a structural perspective to trade, because you can basically make a contract on the fly, right? That's not easy from from a routing brokerage perspective. That's not easy from an OCC perspective. As that ecosystem builds itself out, you'll expect even further growth. So I would expect that to even compound even further.
So the infrastructure and the roads and the toll booths and all that stuff is changing actively as well.
Because of flex option. Let's give you a little bit of inside baseball. So every morning, the OCC tells the exchanges and the brokerage world, hey, these are the options that you're allowed to trade, right? Outside of some intraday ads because of big movements or some corporate actions. So with this flex option space becoming as big and as strong as it's become, every part of the ecosystem that's hung on to that OCC security master, the archetype's been completely changed, right?
Wow.
So now you have to have a database system that can build a contract on the fly. If you're a market maker, you have to be able to price something on the fly. So there's a lot on the line that still hasn't been fleshed out. And as that gets fleshed out and more efficient, you'll see, I would expect there to be more and more volume coming to that product.
Very cool. We could keep going. I feel like we're just scratching the surface.
Yep.
Appreciate it, Jason. Good stuff.
Thanks for having me.
Yeah, really good intel, nice perspective. Can be my market structure correspondent, maybe Matrix Executions, Jason Hicks. Let's go into the trading action. Brent Kochuba from SpotGamma is on the line, and right now equities are trying to maybe grind a little bit. The low of the day came around lunchtime or so. So we are seeing a little bit of improvement, but NASDAQ is still down 1%. S&P 500 is down 1%. I'm looking at the trace tool on SpotGamma right now, and you can see we've made a little bit of ground in the last couple hours, but it still is a pretty rough day here. Brent, what stands out to you this afternoon?
A couple of things this morning when the market opened. I mean, well, let's set the stage. Friday was a lot of very bearish flow, some of the most bearish flow we've seen certainly last month. But I will go back to April to see big call selling in Nvidia, big call selling in Tesla. There was a giant VIX call position that was bought, October 20 strike calls. Huge size there. So there was a lot of hedging flow, a lot of very bearish flow on that Friday. And this was all triggered by the BABA report in the morning, I think. That kind of dented NVIDIA's story a little bit, the fact that BABA was coming up with some of these new chips. You fast forward to today, there was a big October put cover this morning, and that really helped the market to bounce, kind of zap some of the downside momentum. And we've just seen the complete lack of bear follow through today here on Tuesday. So, do you tie a lot of this to end of month, kind of what happened late last week? On one hand, you can say yes. The kind of bear case to this would be, hey, look, fixed strike vol is actually higher than we were late last week, suggesting that there is some hedging coming in still. People are a little bit more worried about some of the economic data coming up. A lot of jobs data. This is like jobs week. We have PMI this week, non-farm payroll, JOLTS, jobless claims. So vols are elevated for those short-dated data prints, suggesting that there's indeed some concerns. But all that being said, the market had the chance to really slam this thing lower, and they really didn't.
Yeah, not much, right? Like I said, I'm looking at it right now. Noon basically was the low of the day. What else should I be looking at here, Brent? It looks like
that low of the day was, pardon me, Oliver. Apologies.
Yeah, go ahead.
The bottom of the day there was 635 in spiders. We bounced right off that level. You can see there's a big condor trade. You can see the kind of ghost wicks of that candle there on the left, right there. So huge 0DT condor. We've been seeing those come in on a daily basis. Now the upside, you got to start watching that one. That's kind of stretched to that upside there, but there's a big position directly above your cursor there. I think around 64.25, right?
Okay.
So those are these 0DT positions that come in. And what's funny about this is that I mentioned the put cover this morning. That put cover was October puts. And then around noon off that SPY 635 level, we saw 0DT calls come flooding in. And so these 0DT positions oftentimes act as a stabilizer, whether it's traders hedging gamma or taking cheap, buy the dip, opportunities with cheap 0DT options. You see those flows come in, and oftentimes they can kind of act again as a stabilizer. Now, Oliver, if you toggle the 0DTE button, just toggle that back and forth, and you see how little the map changes, right?
Okay.
What that's telling me is
a lot of it's coming from zeros.
Yeah, there's not a lot of non-zero DT positions out there right now. I think that one big position that was there was these October positions. These VIX calls are still hanging around, but again, the thing that catches my eye today is that we kind of shift back to data dependency. The bottom line on this is if we hold 6,400, bulls can regain the baton, so to speak. And even if these rolling data points that are coming up, if they prove to not be too terribly material, then we should still, rally here into September. Ugly data points, and if we get back under 6,400, then we have to worry about this jump in vol. We have to worry about Vanna as a negative flow for markets. We have to worry about negative gamma to the downside, and
vortex potential if we get stuck under here.
Yeah, and it's clear we need a data point, right? The flows in and of themselves are not going to shake people out. Like, we need bad data to force the downside, which doesn't always happen. Sometimes people are just in that kind of bearish move, right? And the flows just are too large to sort of fight off. So at the moment, market's shaking off some of this BABA news. You could tag some of the selling as month end, and vol just got a little too cheap, but it's really being digested pretty well.
Brent, what role do you see NVIDIA and the semis playing in this right now? There is a pretty decent sell-off going on in the big tech stuff right now. NVIDIA's got 2.6 million options traded right now. Tesla's at 1.1. Obviously, Q's a ton at 4 mil, and it seems like that's where the weakness is. So after last week, it kind of makes me a little worried about some of this AI stuff, like it ran out of some gas since NVIDIA earnings.
Yeah, and that's the interesting thing is into month end, Nvidia had the largest weighting of a single stock in the S&P 500 ever, right? And so you were coming from this valuation that was just unbelievably stretched, priced for perfection. And so the earnings were they seemed like the earnings were going to skate by is not a big deal. And then a minute later, Baba News comes out and says, "Hey, we're going to create some chips," and that kind of think added to that downside. The thing that's interesting to me, not as a fundamental guy, but if you remember at the end of January, we had the DeepSeek news came out, and Nvidia, from a very similar price point and sort of stance as the leader of the market, just lost 14, 15%, right? It just got
Mhm.
decimated. And, all else equal, it seemed to hold and digest some of this news pretty well. As you point out there, huge volume. So I think the idea of Nvidia trading sort of sideways, but not fully capitulating, people rotating into some other stocks is a viable one, particularly if people kind of aggressively go back into small caps, which on a volume of 1.1 on the IWMs is pretty big, right?
Okay.
So there is that chance of rotation. Tesla
Okay.
had bad car sales, that's getting decked, but I also want to highlight that volume of
IWM is usually not up there that high.
not usually that big. Over 1.1 with still another half hour
Okay,
left.
that's
And VIX
interesting.
volume of near a million is big, especially for a non-expiration day. So I
Okay.
think there was clearly some monetization of this VIX move over 18 towards 20 today as well. So the market, even though it was weaker, people seem to be taking advantage of that dip, selling options, selling VIX, spikes. Vol has kind of normalized, and if the data is no big deal this week, then I think we can kind of just put our rally caps back on, and this was just sort of a little dust up.
All right. I'm looking at the scanner here, which I like this quadrant of high IV rank versus risk reversal rank. High IV
Yeah.
being going up to down. A lot of this stuff still in this bottom left quadrant. Cheap volatility, upside potential. We did talk about how the calls for the overall market were pretty cheap last week. I mean, is that why? Because we faded here? Are they getting even cheaper? Or I guess not, because vol's picking up a little bit.
There's been a ton of call selling. So call selling was the way to express Nvidia was kind of overbought, or Tesla was overbought, or Apple was overbought, and that suppresses call implied vols, obviously, right? That's much different from buying puts, because as puts, if you buy puts and the market goes down, hedging flows, will push the stock faster, vol should spike, right? So in this case, it's more like people have seen or playing for a cap in Nvidia prices as opposed to the expression that the stock is going to drop sharply, right? And that's kind of the big distinction there. The
Okay.
QQQ calls right now, you can make the case that they're very cheap, right? Because the other thing to note here is even though we're moving down, those implied vol ranks on your screen are quite low, right? And those are Friday's closing implied vol. So even though there was this big selling, you're not seeing the vol spike in a material way, which is a sign that people aren't playing for a whole ton of downside. One thing I do want to point out while we're on this
Mhm.
screen is gold is ripping. It's up
Yeah.
around the GLD ETFs are around 325 right now. Those calls are pricing as getting expensive. If GLD moves to sort of that middle of that chart, then I'm going to be seeing gold as overbought, right? Just from an options perspective. When you
Okay.
see high implied vol rank with expensive calls, that's oftentimes a short-term topping signal. So if you're long gold, I think that's what you want to watch for. Is that stock up, vol up really forming? And gold could kind of be starting to sniff that as we
Mm.
update the data into tomorrow. But that is certainly the standout winner to the upside.
Seriously, gold, man, just a beast. Absolutely, 36 right now. Even after a couple little hits from the high of the day, just a beast of a day. Also, kind of interesting too that gold's rallying while the dollar is having a firm day. The macro stuff is so messy right now. But I got a guy that's going to try and help us figure that out up next. Brent, thanks a lot. Nice. Glad we got you. Appreciate that. And for those following along, that QR code gets you a free flows report from Brent's team at SpotGamma. And it's really good stuff. All the things we've been talking about here every day. Appreciate it, Mr. Kochuba. Coming up next, let's talk about the macro. It's a little bit confusing here. Everyone's expecting Powell to cut, but then the dollar's got this little uptrend going on. Bonds selling off today. The PMI is looking pretty decent, but we've got gold ripping. Coming up next, James Perry joins me for a look at a really interesting perspective that's going to wrap some geopolitics into it too. Be right back. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. SIBO is on a 5-year growth streak making billions. And its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from SIBO, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to the SIBO floor. I'm Oliver Rennick. Let's talk some macro. It's an interesting situation today. Bonds selling off a little bit. The dollar is firming and gold is breaking out while stocks come under some pressure. Joining us is a very interesting mind on markets. Mr. James Perry is the founder of Perry International Capital Partners, former Chicago guy as well. I guess now you split your time between Miami and Chicago, right, James?
Correct.
Tell me about your background. You were at PGym prior. You have experience at Arbor as well, which is shop of Jim Bianco. I think a lot of folks know from Chicago. You were at HSBC. You were in London. You're a bond guy originally. Give us your kind of 60-second background.
Very simply, out of school, the only job I got was on a trading floor as a trader, as a trainee.
Yeah.
It stuck, and I really liked the global macro from the very beginning. Took a lot of finance classes and enjoyed just knowing the numbers behind everything before anything else. I didn't like the story. I liked the skepticism and the insight that pure numbers give you. So I'm a math guy, and the idea in math is there's one right answer. There's not two. So to me, it was always about global macro, central bank liquidity, where interest rates going, because interest rates drive everything.
Okay. Right now, there's kind of an interest rate conundrum because the markets are saying right now, CME futures are over 80% we're going to cut. I'm watching the dollar kind of steadily climb over the last couple months, and usually that dollar doesn't firm up if the Fed's going on some big cutting spree, or what do you think?
That's right. Well, there's the saying in bond land that the FX market gets it first, right? So if the dollar's moving up, that means the FX traders are thinking the odds of a rate cut are slimming down a little bit. Now, I know the SOFR futures are 80% or 75% or something like that. You got to remember who trades that stuff, right? It's all the big banks. So they want cheaper money. And I think, in a way, if you look at where the Fed funds rate are and you look at where the economy is, on the surface, it seems absurd to cut rates, really. Like, if you just think about it, stocks that are all-time highs, housing market all-time highs, automobile prices all-time highs, unemployment 4.1%. The economy seems on the surface to be
pretty solid,
doing pretty well.
Household wealth more tied to stocks and risk assets than ever.
Private wealth in this country, Oliver, are $170 trillion. Think about that for a second. GDP is 30, right? All that wealth is private wealth, and anybody that owns an asset has been a beneficiary of inflation for the last 14 years, right? So the S&P is up, 16.5% per year for 14 years? That's unheard of. That's all about money.
I guess the flip side would be then is what kind of the argument is why not loosen the real rate if inflation's though also coming still down off the peak and has settled at least. Do you have to have a real strong view that inflation's going to flare back to not want to cut just to kind of be safe at this point?
Inflation is a tricky subject for a lot of people. Sometimes people misunderstand it. They think about eggs and then they think about insurance. Two different things, right? Goods inflation has been coming down since the pandemic. That's clear. They continue to come down, which is surprising a lot of the people that said tariffs are inflationary. They have not been to date. Maybe they will be, but...
Do you think that's an easy equation to figure out or no?
I think that most of the Christmas buying season, which is basically 50% of retail profits, right? All of that stuff's been bought for 6 months. It's here. So I think you're already looking at Q1 sales, and the prices right now have really essentially been unchanged in basic consumer discretionary stuff. Christmas presents, birthday presents, things you don't need. But the problem with inflation is the government is the only root cause of inflation. It's fiscal deficits, right? And I think that this big, beautiful bill, it would have been really nice for bond traders to see some cuts in spending, and we didn't get them. National debt's still banging up against 38 trillion. The budget deficit is $2 trillion, right? I mean, the government brought in $5 trillion worth of revenues and spent $7 trillion. Pre-pandemic, they brought in $3.5 trillion and spent $4 trillion, right? So you're talking about a fiscal deficit that's quadrupled in 4 years, right? This is the problem. It has not been addressed.
What's the time frame we need to run that correlation? Because the counterpoint would be, to your point, we've been spending nonstop, whether it's this guy or the last guy or him before.
Right.
And we seemingly can trace that inflationary big up and down, one could argue, to some of that supply chain shock.
For sure.
If the inflation chart doesn't correlate directly with the deficit and the debt chart, then do we go, hey, maybe this stuff is, or is it just lingering like this quiet beast that has some asymmetry to it at some point?
Right. The problem is the size, right? I mean, it's been growing and growing. The good thing about the bond market right now, 10-year yields were at 380 in January. Now they're 480. They're 4.25 right now, right? 4.25. 427 today, but they've really been going sideways for 3 months, 6 months, right? And they're still about 100 basis points higher than the pre-pandemic level. So that risk premium for this deficit spending and national debt is being built into the market. If the government did cut spending and reduce the national debt in the last 3 months, you'd probably be at 3.5% in a 10-year yield now. You're not because of that, right?
So it could be even more reduced.
It should be, right?
Sure.
Goods inflation has been coming down, and the world is deflating. I mean, India is exporting deflation. China is exporting deflation. These are the two biggest countries in the world, right? So they need to continue to produce and cut costs to do it because their marketplace is here. That's why tariffs are not inflationary. But service inflation is really about the cost of money. And, you know, everybody who owns an asset, house, pension, stock market, they're doing great.
Sure.
But what about that cohort, that sort of young group of kids, sort of 35-year-old kids, 25 to 35-year-old, who are shut out of the housing market?
Sure.
Why? Mortgages are at 6.5%. They should be at 5.5% or 4%. Housing market would pick up. They're not, because the cost of money is too dear. And if the Fed cuts interest rates from 4.5% upper bound to 4.25%, are mortgage rates going to go down? Probably not, right? There's a credit spread there, right? So more people are getting more mortgages.
When the Fed started cutting, yields went up.
Right. So mortgages aren't necessarily going to go down no matter how much Trump tries to push the Fed into doing something that they really don't want to do.
Right. In some ways, it has that kind of blowback effect if it ends up inflating asset prices further or supporting, juicing the economy.
Exactly. The biggest problem, the reason we have a new administration, is that middle class, their cost of living has gone up 30%, 40% in the last 4 years. They said, please cut spending. We are getting killed, and there's no way around it. And the government didn't do that in the last month or so, right? So they think, okay, and Scott Bessent's a pretty smart guy. You know, I have a lot of time to listen to him and a few other guys in the administration, but he's trying to argue that the government would really appreciate lower rates because it would help everybody. Well, it doesn't work that way, right? Markets set the prices. So to me, it seems like the only way real service inflation is going to go down is if government spending and national debt actually has genuinely, there's an effort to reduce it.
Now, when you look globally, because I know you have experience, you think global, you think big picture, a lot of this stuff that seems like it might be this overhang or threat here, you look around the world and it's like, well, what's your better option? I asked the AI for a geopolitical trade, something international. I wanted to get your thought on it here as we consult the machine to try and come up with some ideas. That's not me, by the way, even though it looks like me. I said, what's a geopolitical trade to carry into the end of the year, and how can you execute it simply? Response says the headlines scream war risk, but the smarter angle is fiscal inertia. Once defense budgets rise, they rarely shrink. So this trade is actually going on kind of the defense side. While Europe's industrials face higher energy costs and contracting exports into winter, that sets up a relative trade. long U.S. defense contractors, short European cyclicals, buy U.S. aerospace and defense ETFs, paired against short exposure to European industrials, forget the war talk, the real signals in the budget math. So this is kind of a little bit of a contrarian trade to what people were doing earlier in the year to some extent, I feel like, about the whole NATO funding and stuff. What do you think?
That's right. Spending is a problem everywhere, right? I mean, the biggest difference between the United States and Europe, for example, is here it's individual freedoms and individual choice. In Europe, it's really the state kind of mandates things. There's a great safety net there, great safety net. But the trouble is that Europe really isn't growing, right? So the only way that they can manage the safety net is print more money. And that's why these yield curves around the world are steepening. Japan, UK, France, same thing. So here, I really think that the 5 biggest issues in this country are taxes, deregulation, government spending, trade deficit, and national security, right? So I was over in Europe, Q2, and wanted to talk about all 5 of those things.
Okay.
90% of every conversation at every meeting was about tariffs, right?
Yeah.
And when I did a video in Zurich when I was over there, and I said, man, this is an asymmetric bet. These guys are just so wound up and so angry that they're going to have to, reduce tariffs and get things back to a fair trade thing, that they can't see past the idea that there's a lot of good things going on in this country, and they should be talking about it and investing accordingly, rather than just worried about tariffs, which are going to go away, right?
If you pay a higher cost, the margin goes up, but it goes domestic, then that money comes back around into the system in theory.
Correct. So when the downtrade in the stock market came in April, I was over in Europe, right? And I just said, this is a goofy trade. I'm not going to get involved with it because the market's going to go up.
Right.
And as soon as I get back to Chicago, I'm going to buy some more tech stocks, right?
There you go.
So Perry Capital Asset Management is having a great year because we just look at the global picture internationally. And if you just say, that doesn't make sense, that's an emotional trade. So ignore them. Investors internationally have to understand that the market trades off of different things at different times.
Yeah.
And if they get so focused on the emotional issue of the day, which they see every day in the papers and on the news,
there's a lot of whiplash.
Not only is there whiplash, but they're making decisions based on emotions, which are going to change. It's not reality.
Yeah. The AI trade doesn't have emotions.
Right,
it's
right.
Just pure tech.
So the AI response that we just got here is very similar to the one I have. You know, I have a S&P 500 fund, basically beat the S&P every year with less risk. So I overweight asset allocation in different sectors. I'm overweight tech and defense stocks,
there you go.
and underweight REITs and healthcare.
Okay.
And guess who's winning? Me. Why? I mean, that trade, it's not just me. It's been a pretty easy year to invest, in my opinion. But the point is, you have to be selective on what's happening in different sectors of the economy around the world to make proper investment decisions.
AI is taking a little bit of a hit today. NVIDIA down small, but it certainly has been the trade of the year. Jim, fun conversation. Good stuff.
Thank you very much.
Love the perspective.
Appreciate it, man.
Yeah, good, fun, macro, lively discussion. James Perry joining us here at SIBO. All right, when we come back, we're going to talk some big themes and how to think about a few of those cyclical items from the perspective of $1 trillion plus retirement behemoth that is Empower. Marta Norton joins us when we come back. Welcome back to Chicago Future of Finance. Let's talk markets. Let's talk big picture, long-term, nest eggs, and retirement. Joining me here, Marta Norton, who's the Chief Investment Strategist at retirement behemoth Empower, with nearly $2 trillion in assets under advisement, right? Like 1.9, is that right, Marta?
It's a great deal, is all I know.
Right. Okay. So how do you think about markets? We've been talking markets for a long
Yeah.
time, but kind of from the perspective of the show where we've been thinking about strategy and product and people.
Yeah.
How do you think about markets like on behalf of that many people? Over 10 million clients
Right.
that are serviced at Empower.
Right. I mean, 19 million customers. And I
19.
think, one of the things that I think is so key when we think about retirement is people's retirement nest eggs, their 401ks are one of their primary, largest accounts invested in the market. And it's, so critical because it's going to fund their retirement. And so getting people to have the right orientation, the right expectations for what those accounts should look like, helping them think about what diversification looks like, what it doesn't look like. And I think really framing kind of the current context in light of those long-term goals is one of the most important parts of my job.
What do you think? Is there a issue or a common mistake or leak that people have when they're I finished my job, I've got this 401k, or I'm retired?
Yeah.
Is there a common thing that is like low-hanging fruit to fix for that group of people right now?
Well, one thing that I think comes up repeatedly that actually is not much of a problem, a lot of folks think that when you think of the individual investor and there's some sort of market disaster, that there's a lot of repositioning or pulling out of the markets. And you can see that on the margin with retirement investors, but it's not something that's happening in mass. So in some ways, there's pretty good behavior within portfolios if we're looking on kind of the average experience. But I think a lot of it relates back to financial planning. How much are people investing in their portfolios? Are they capturing their entire employer match? Are they thinking about their investments and understanding what those investments actually are? I think a lot of times people lack some of the basic education around how do you put together a portfolio that makes sense for the long term. And so helping people have those basic understandings is, I think, a pretty important job number one in that space.
That's important clarification too, as I was kind of framing it as people who are maybe toward the end of their career, but
Sure.
You're also setting people up, you're building strategies for people as they're starting
That's
out
right.
as well, thinking ahead.
That's right. So there really is that continuum, right? There's those newer investors who stay new for a long time because the, life cycle of a retirement account is pretty long. But then there are those people who are nearer to retirement. And again, I think all roads lead back to financial planning on that front.
Yeah. The thing right now that seems like a major theme that keeps coming up is for those that maybe are kind of deeper into the cycle of their investment.
Yep.
They're sitting on big gains.
Yep.
As James was just talking about, as far as it relates to the markets and the health of the economy,
Yep.
household wealth more tied to assets than ever,
Yeah.
whether it's individuals, whether it's families. And how big of a challenge does that become when they've got money in investments,
Yeah.
but they don't want to sell them because they got to
Yeah.
take capital gains, or they are concentrated in certain
Yep.
positions? How much of right now the investment world is kind of oriented around creating liquidity for that?
I mean, I think it's a really key question. And I think there's actually a behavioral element to that. I'm reading a book on retirement right now. And one of the things that people talk a great deal about is moving from an accumulation mindset to a decumulation mindset. You spend all your time and all your efforts learning how to grow your portfolio. And all of a sudden, you're no longer growing it in the same manner or contributing into it, you're drawing it down. And so having a mentality that even allows you to tap into that is a really important kind of step number one.
We've had a lot of people on the show so far that are obviously, and we've kind of geared it this way, but using options
Yep.
to build strategies. How much of that belongs from a retirement perspective? Can you get a little juicier, a little riskier, a little more kind of avant-garde adventurous in using some of this stuff that is trying to preserve wealth or is trying to
Yep.
create liquidity for people?
I think there's a lot you can do, especially if you expand your horizon to the totality of your portfolio. If you're thinking just within what are my options within my 401k, that might be a different conversation
Right.
than what are your options when you're looking at,
Right. So your
yes,
plan
your
limitations
401k,
there.
but yeah, you're taxable. Yeah. And then taking into account kind of the planning guidance that you're getting there.
Yeah. Okay, so let's talk some markets then.
Yeah.
Bringing us into the now. We talked some cuts. What are the main things that you're thinking about from a market perspective that have the ripple effects outward into the retirement world? Because if you're a trader, you're thinking about, everything.
That's right.
Whatever your edge is, your angle on the short term. But when you're trying to analyze markets, and you're a great market analyst, how do you try and then go, okay, the ripple effect for 10, 20, 30, 40 years? How do you figure out what matters now?
It's tricky. I mean, I think there is kind of an ever-present question of what's happening in the markets and what does that mean for expectations. I think that is really critical. And so that does relate to what's happening over the next 6 months. When is that Fed rate coming? And then what's the cutting cycle from there? Where are valuations? What should I expect from my equity portfolio so that I'm not disappointed if things fall short? But then I think longer term, what do those fundamental building blocks look like? Where are earnings today relative to history? What is the AI theme? How transformative is that? How does that push back against the deglobalization theme, which arguably should be a drag on earnings? And how do those two come together? So those are some of the longer term themes that I've been really wrestling with lately.
Tell me about how the AI side fits into it.
It's fascinating.
The concentration of the market, is that something that people should feel comfortable with if their retirement or their long-term or their 401k is index-based and index is becoming more concentrated? Because I've had people come and argue that they should be more international, they should be diversified, but a lot of those things just keep underperforming.
I know. It's so the concentration question is one that we're going to have to grapple with for a long time, because the AI theme does reinforce that a bit, at least for these early stage winners. When you do look at portfolios, even within the retirement space, you do see this heavy home bias, which makes some sense based on where your liabilities are, but it also reflects just the tremendous performance we've seen out of U.S. equities and this bias toward what's performed well over the past decade. I'd argue that it makes some sense to have some global diversification. We see that
momentum
even
this year.
That's right.
It is beating this year.
That's true. And you see that from a currency perspective too, right? The US dollar has been a bit of a difficulty, relative to what we're seeing overseas. So I would argue that diversification makes some sense. Even alternatives within a 401k can make sense. It's all within the context of the total portfolio.
Speaking of alternatives, the other one that's hot is obviously private assets,
right?
Working their way into different parts of the wealth world. Does that belong in a long-term kind of retirement-focused mindset? Because the main thing people argue is, okay, it's not liquid. But I guess if I'm putting it in a portfolio that I'm not going to touch for 30 years, maybe I don't care about liquidity.
Maybe there's
so much.
some alignment there. This is such a hot button issue. It's been so interesting to see people have such a reactionary perspective on this. Here's what I would say about alternatives or private assets within a 401k. When you think about the U.S. equity market, and that's what people want exposure to, U.S. equities broadly, you can't just focus on public markets because so much of the market today is private. So if you really want exposure to the breadth of the U.S. market, you need to have private exposure in your portfolios, but you have to acknowledge that they're not the same as public equities. They don't have the same liquidity profile. They arguably have higher risk depending on what they are. They require a certain measure of due diligence. The structure is different. So when we think about something like that, we'd argue it's much more logical to put that in an advice product where there is some sort of oversight of it, rather than just allowing people to pick it on its own,
a little
within a
extra
lineup.
Step of due diligence.
That's
perhaps.
right. Yep.
Great stuff.
Yeah.
Marta, always love your perspective.
Good to be here. Thanks for having me.
Absolutely. Fun to wrap the market analysis into the long-term picture.
That's right.
That's Power. Marta Norton, Chief Investment Strategist at Empower. Great stuff. Coming back, let's look at the risk radar. Let's look at some of the momentum trades with Charles Moon. 1 minute. few quick thoughts here for the risk radar. Let's check it out because the adjustments that I made over the last 2 weeks have borne some fruit, but I'm still a little bit lost in the woods when it comes to some of the macro. I think Marta and James' takes there help clear up some of it. We probably are going to get a cut, but what it means for bonds and the dollar, I'm still unclear. However, the dollar move that shifted, as you see there, the dollar sign symbol closer to the green on that fringe between yellow and green is on top of my mind today as the dollar is firmed up again. Now, the question is what that means for bonds. Usually when the dollar's firming up, it means yields are firming up with it, which doesn't really look like a strong message about cuts. But recall that when the Fed started their cutting campaign a couple of years ago, it actually led to higher yields. And that's that kind of convexity, the butterfly effect of what happens if you cut while the economy's strong. So maybe we get higher dollar and maybe we get higher yields again as the Fed starts cutting. That means I'll be watching bonds pretty closely. As you can see, that little Fed symbol there for my bonds close to the red. That's still yellow, but inching towards red because it looks like maybe bonds want to break down. Not quite yet. My question to Charlie here is what that's going to mean for some of the Momo stuff because the tech trade's getting dinged up, Mr. Charles Moon, coach of Prosper Trading Academy. What do you think about the session here today, Charlie?
Pretty interesting. Quite honestly, going into the weekend, I actually thought the news was bullish, especially for retail stocks and, more of the smaller caps that, would have to loan at the higher interest rates. But then I totally forgot that the U.S. would have to pay back all of that money. And certainly the reaction today was very negative. So it's good to see how resilient the market is once again. Let's not forget we made new all-time, never seen before in the history of mankind highs on Thursday.
True.
The SPY. So, we're not at any, real danger point from a technical standpoint, from a pricing standpoint. But it is interesting that today was the first day the Qs were underneath the 50 SMA since I believe May or April. So, there's definitely some weakness. We saw the signal in NVIDIA. They came within a penny on their earnings day of their all-time high price and dropped like a rock. AVGO, which has been extremely resilient, was down, quite a bit on Friday and opened down today just to finish barely positive. So it's kind of interesting to see how tech is developing on this tariff news, at least for the short term.
Yeah, NVIDIA right at 170. It managed to hold that 170.74 as we just rang the bell. It looks like an area that should find some support. I mean, I'm looking at a gap from 164 up to 170 from back in late July that looks to, or late June, that looks to me that kind of gap up there to where we are like something that should hold some support.
Yeah, and if it doesn't, then I see it breaking down, and I know this is going to sound funny, but I see this actually breaking down pretty hard to the 155 price level. I think NVIDIA just closed underneath their 50 simple moving average. And I think the last time they did that, it was on May 1st. So, again, you're just starting to see a little bit more cracks in the dam. We're not flooding just yet, but the market. We saw this leading into the week, leading into Jackson Hole, where there was a lot of shaky trading in some of the more stronger performing names, stronger trending names. Maybe this is a bit of a rotation out of the semis and into cloud. Cloud was such a good performer on earnings with Mongo and Snowflake. Maybe that's part of the reason we're seeing a little bit more weakness in some segments of tech and strength in
That's
others.
interesting.
It's a weird dynamic to see NVIDIA, find a top and then, really react negative over these last few days.
Yeah, I didn't realize that. I'm looking at CLOU here. I didn't realize that cloud has this now kind of full month trend to the upside. Got hit today too, but to your point, a little bit better on that intermediate term in the last month. Whereas if I flip back over to SMH, to your point, boy, you really got to hope these things hold, whether it's semis as a group or NVIDIA too. What about the bounce in Bitcoin and Master today, Charles? Does that help alleviate some of the nervousness maybe over the past week in coins, in the coin-related world?
I think the last time we talked about this, I had pointed out there's been a bit of a rotation from, Bitcoin holders into more Ethereum and some of the altcoins. But we've seen a little bit more progressive weakness there. Bitcoin came roaring back today. And again, with at least with me with crypto, sometimes there's no rhyme or reason. Sometimes trend
Yeah.
is sustaining, and then all of a sudden it breaks trend and goes on a multi-day tear, and it'll recover what it lost, in just a few days, in just a few hours, and vice versa. So, I for me with crypto, it's always a short term, you know, um, momentum play. I actually like the miners a little bit more than MSTR. If you
Okay, you
look
got a
at
ticker
stocks
for
like
me?
IREN,
Okay.
IREN is one
Oh,
of my
that's the
favorites
popular
right
one.
now.
Yeah.
Yeah,
Oh man,
they've been
big bullish
crushing,
engulfing candle today.
and
Is
Hut
that what
is
that
another
is?
one as well.
What's the other one, Charlie?
Hut, HUT.
Oh yeah, I know Hut. Yep.
Yeah, so these two have been the standouts. I know a lot of people like Mara and Riot, but these are the two that I've been watching really closely. There's a
Those are good looking
sneaky one
charts.
that actually has coverage from JP Morgan called Cypher. That's CIFR. And that's another one that's starting to creep up as well. But, like I said,
Wow.
it just seems like there's a rotation, and the rotations having rotations. And this is where it's difficult for like the retail traders to try and play catch up all the time in the market, because trading at these all-time highs, anytime there's news, there's a surprise. It's a very, pretty volatile reaction. It's not typical to see the Qs open up, down 1.5%, but we've seen it here and there as of late. And that's just something we just got to have to trade around in this really bullish market overall.
Yeah, those are pretty good names there to watch. The miners, I gotta say, those are some of the best looking charts on the market. I mean,
Yeah.
I don't know what the timing is about, but to your point with crypto, sometimes it doesn't have a rhyme or a reason. I mean, I know that some of those kind of hot names. I know IREN obviously was like a major Momo name, but the fact those all had monster days today, while the market is down, I feel like gives a little hope for at least one angle of the crypto stuff for now, because those are pretty decent looking charts.
Yeah, the common denominator is actually AI. That's something that they all have in common, and that's obviously been the key word here for the last 2 years. But yeah, those are the standouts, and it's specifically because of the ties to AI.
That's why I love you. Always give me some names that I missed, the juicy stuff to watch. Charlie, you the man. Thanks for jumping on.
Thanks for having me, man.
Appreciate it, Charles Moon. A couple good looks there. Pretty good charts in the miners. Thanks for joining Chicago Future of Finance. By the way, before we go, a very special shout out to my own family, the kin. My brother Luke turns 40 today. Happy 40, Big L. Wow, big number and well-deserved. And if this were New York Future of Finance, he'd probably be featured on the show, because not only is he a great brother and a great father and husband, but he's kind of a Wall Street fat cat too. So shout out Big L. Happy birthday. Looking pretty good, pretty decent for 40. All right, thank you for joining Chicago Future of Finance. I'm Oliver Rennick. See you tomorrow, same time, 2 p.m. Central Time, Chicago time.